morning and good afternoon to day two and to this panel where we'll be looking at the global economic network and what it means to the financial community. First of all, I would like to ask everyone to introduce yourselves and tell me, not necessarily going into any detail, but tell me what the biggest risk is to your business coming from distributed ledger technology. Yuval, can we start with you, please?
Hi, I'm Yuval. I'm the co-founder and CEO of Digital Asset. And the biggest risk for me from a blockchain technology is that our competitors will beat us.
Thank you. David, can we come to you?
What is the biggest risk? So first of all, David Newns, I'm head of SDX. I've been in the capital markets for 20 years, SDX being Sixth Digital Exchange, the first example of next generation stock exchange based upon blockchain technology. The biggest risk to us coming from distributed ledger technology, I think not playing the appropriate role in the marketplace that a financial market infrastructure should be providing in the FMI, in the DeFi space. I think there are aspects of distributed finance where a financial market infrastructure provider should be participating and helping with national infrastructure when it comes to participating in DeFi for the benefit of investors.
Thank you so much. Scott, can we come to you, please?
Yeah, thanks, Eva. Hi, my name is Scott Lucas. I'm head of Markets DLT within JP Morgan Markets business. I guess if we accept that blockchain DLT has a role in the financial markets, I think the biggest risk for us, if we sort of try and service our clients that way, is lack of adoption / sort of fracturing of that market in a way that we don't get the full value out of the technology, and we don't bring the market together to realize the full value.
Thank you so much. Well, this panel might be useful. Who knows? Mathew, can we come to you, please?
Yeah, hi, I'm Mathew McDermott. I run the digital asset business at Goldman Sachs. I've been at Goldman since 2005, and I've been running this business for just over 2 years now. I'll put a little spin on it. I see it as a huge opportunity, DLT. So I kind of think of that, the opportunity set. I think the biggest risk, quite frankly, is apathy. So, yeah.
We found the optimist on the panel. Thank you. And Michael, can we come to you, please?
Yes, thank you. My name is Michael Wagner. I'm a partner at Oliver Wyman, and I'm in charge of our global market infrastructure and digital asset consulting business. So biggest risk, I think, is if there's widespread disruption without dispersion of value, right? I think that's more, because if our clients get disrupted, that's a risk for us.
Thank you. We will come back to hopefully all of those points shortly, but firstly, I would like to ask Yuval to introduce the idea of the global economic network to us in a little bit of detail, and maybe just a little flavor of what is the problem that you are hoping to solve.
Thank you, Eva. And so I wanna allow others to chime in, but from my perspective, as the first use case of a global economic network was Bitcoin, that truly said, can we actually create a global economic asset that is not relying on one party to make sure that it runs? And I think that sparked a whole bunch of ideas and innovation where we are seeing more and more businesses that sometimes are even competitors, even here in this panel, but also are looking to collaborate in many cases. And when you think about historically the architecture of financial services, it was very hub and spoke. And even when you're seeing in the last 10 years that, for example, open banking started becoming a thing, the systems that were going to provide the information to build these type of systems and applications were not designed to be really collaborative by design. So a global economic network is, first of all, an architecture concept. It's how do you build the system, the financial systems of tomorrow, to allow to have this collaboration and composability between competitors, partners, and the likes. but then after that, we believe that it will create business or new business models that today people don't even think about. I mean, people started mentioning DeFi as an example. That the idea of DeFi is really taking existing financial services concepts like exchanges, like lending, but really thinking about how can we provide these type of services on a new type of infrastructure. And hopefully by doing that, a lot of people talk about disintermediation. I think about really opportunity to make things more efficient and as a result to create more business opportunity. And a lot of times, if your entire business model is really how do I connect A to B, that's really your only value proposition, then yeah, new technology that makes the world more efficient is a risk to you. So to me, a global economic network is how are we designing from a technology perspective the financial system of tomorrow, and then really thinking about what are the business opportunity as a result of these new architectures that are going to be more prolific.
Before we sort of unpack that any further, you mentioned, the idea of disintermediation. We're, on this panel, we have banks, we have exchanges, we have technology companies and consultants. Blockchain technology was supposed to disintermediate all of you guys. So can you tell me a little bit about how it's going to be, this new system, be more efficient if we're just building it new, basically?
Yeah, no, I think the efficiency really comes from the exchange of information, right, between the various actors. So what this new technology or blockchain technology generally allows is a more efficient direct exchange, right, giving the actors within the network also more control, right, both over their own data and their own information, but also how they want to interact and what things they want to share, right? So I think that's truly new, and that allows really for a redesign of business processes, right, which are cheaper and more effective, but also allows capital reduction and risk mitigation, right? Because the networks can often act faster because they can, they connect end clients and end users, right? But also the auditability of a DLT-based network really allows more self-certification, more, and more risk reduction by definition. So we think those are the key elements that really will lead to massive efficiency gains for all the participants in such a network.
Yeah, and I certainly echo that. I mean, as we think about, applying this technology to different businesses, within the firm and actually working closely with our clients, I guess kind of risk reduction, is a key component of that. And if you kind of break that down, that's kind of operational, settlement, and even liquidity risks, which have an impact on capital. So you can see very quickly how this can be kind of both risk reductive, but also economically very efficient. I think the speed, the accuracy, the immutability are all very powerful features as well that really can transform and improve. A lot of markets today where there are a lot of intermediaries, there's a lot of clunky processing. And I think over time, you'll see it expand to a much broader universe of businesses.
I think what we've done on SDX really resonates with what I think we've achieved at SDX in terms of leveraging blockchain technology to do exactly that, to actually facilitate faster transactions and to eliminate certain parties involved in the settlement chain. So moving from having a T+2 settlement to instantaneous settlement atomic swap, where the trade and the settlement are indivisible and there's no counterparty risk associated with that. That is clearly a benefit that the technology has provided, and we're actually, that's actually available in the marketplace today. So I know Eva said that all this technology is meant to sort of magic away everything and make the world a better place. I think we've got to do that, one step at a time. But I think that what we've achieved at SDX is clearly a pretty significant step in that particular direction. So it's really happening, and it's happening now, but it's not going to be an overnight change, right? It's going to require a lot of collaboration. I think what Yuval was sort of alluding to as well. These are global networks we're needing to put together. They have many participants, all of whom need to be able to adopt the technology, integrate it into their existing systems to actually take advantage of the functionality, the benefits of the technology. It's not something that you can just plug into the existing financial markets infrastructure, because it is, by its very definition, the financial markets infrastructure of tomorrow. So we're kind of making it up as we go along. We're inventing the future, and that is quite an effort, and an effort that requires coordination and collaboration across a lot of parties.
I would like to say we're not making it up. We're kind of strategically thinking about the best way forward, but
we're inventing, yeah. Making it up.
Strategically creating, but yeah.
That sounds much more
reimagining, if you want the consulting.
Oh, even better, yeah.
The disintermediation question, I think, is an interesting one, because another way of looking at that is just sort of bringing new levels of competition to what should be a competitive marketplace. And I think that's a good outcome for clients. It's a good outcome for the market, for us to rethink how we could, provide better services, etc. And really, the roles of all of the institutions that are represented here today is to sort of service the market that wants to see better capital flows between entities, jurisdictions, and companies, etc. So we should be, I think, embracing the fact that change is upon us. I think we should be looking to sort of see how we can harness some of that opportunity to do new services, etc. And it's happened before, whether it be about simple things like the electronification of equities trading, or just the moving from bearer securities to dematerialized securities, etc., and some of the efficiencies that are brought around there. So it's just another wave of that innovation hitting the market from a different technological angle, and it should give us really good opportunities to do some things better. That comes at a risk in some parts of our business, but if that's a reflection of kind of how the market needs to operate and wants to operate, then we need to adapt that and adopt to it. Adapt and adopt that in a way that kind of gets the best benefit out of it for us.
So in this brave new world that we are strategically heading into or making up as we go along, what's going to happen to competition? I mean, is it all going to be super collaborative, and JP Morgan and Goldman Sachs will be one big happy family sharing, clients and happiness? Or can you just sort of paint a picture to me, guys?
And the lion will, the lamb will lie down with the lion and all that. I think that's not quite the picture that I was painting. I think collaboration does not exclude does not exclude competition, and that rather tired phrase of terminology of co-opetition is what we're seeing. So everyone is going to benefit, but that doesn't mean they can't stop competing with each other. We are as SDX, our members are we're user owned. Our members are our owners. And they're all competitors to each other, but they're all collaborating to actually support, sustain, and extend the SDX initiative.
Yeah, I think a lot of points spot on, actually. Sorry, Michael. So I mean, I do think naturally, every firm is competitive in terms of, its own strategic direction of travel, but without cooperation, and, Scott and I work very closely together on certain projects, without that cooperation, you really struggle to get adoption. And I think the best way to get market adoption is work very collaboratively together. And in fact, the only way, and that will expedite adoption, which is to the benefit, I think, of everyone who is looking to kind of progress in this space.
Mm-hmm. And then we compete, but there's nothing to compete over if there's no market that's been created. I think that's the sort of sequencing of it. So like creating the right amount of critical mass around different products or different opportunities in the market, that takes collaboration. It takes collaboration not just between, JP Morgan and Goldman is the example you gave, but it also takes collaboration with regulators. It takes collaboration with clients at sort of both ends of the investment spectrum. It takes a sort of broad church to get us to that particular point. And once we're there, actually, then we can compete. And that's, again, in the interest of the market, because then we've got the right participants in the market offering the right services and being able to change those and fine-tune those and get better at those in a way that the market gets more and more efficient. But you've got to create that. You've got to create that set of circumstances to enable that competition in the first place. And that's going to be one of the challenges to Matt's point around adoption and getting the market.
Yeah, no, I would say it's a process that it's to some degree a learning process, right? I think, as everybody said, if you want to create a network, you also need to get clients to adopt it, right? And the clients are often very similar, so there need to be incentives for the clients to do it. And I would say the banking industry or the financial service industry has been successful in some of those. So I mentioned Zelle in the payments industry, right? The banks came together to create something that is useful for the end clients and in which they can cooperate.
So do you guys...
Actually, one other
Yes,
one other point I was going to make actually, and this comes into, I guess, the general philosophy in and around the global economic network, because as you think about, the adoption and the competition, etc., obviously there's a lot of different, and I think in the report it quotes 100 different blockchain protocols, but there are naturally people who are working on different layer ones. And so I think that this kind of application layer is very powerful because that does allow that seamless adoption, across different kind of, I guess, institutional types, but also different kind of marketplaces.
Thank you. I'll ask for a couple of examples in a minute from you guys. So if you can maybe draw some up whilst we tackle this next one. Can you, some of you mentioned critical mass and client adoption. I thought clients wanted this. Is that why you're doing this? Can you tell me a little bit about what are the kind of factors that holding back adoption? What are the kind of common concerns that you see? And, maybe propose some solutions.
Yuval, I think you probably want to start off, right?
Yeah, I'm happy to. So I think that first of all, we are talking about a technology that is supposed to create new markets, as Scott mentioned and Mathew talked about, and therefore the consequences are quite significant. And I know that there has been quite a lot of hype in the last, especially since 2015 to 18, and then a lot of demand. Where is it? Where is it? But at the end of the day, creating new markets take time, even on traditional technology, let alone on new technology. So I think that what has been proven over the last few years is that the underlying technology works and can scale. I think where now, first of all, there are plenty of projects that are already running in production. Mathew discussed JP Morgan is doing significant amount of payments every single day on the technology. So I would actually say that the technology is being used. David mentioned SDX with the bond issuance platform. So there's plenty of opportunities where this technology is already driving quite significant markets. That being said, I think that no different than with any other new technology, what you are going to start seeing is now much more tools that allow customers to build more sophisticated applications faster. So if you just think about AI was, in the news for such a long time, and it's like AI, everybody was talking about AI, but it was a new technology that people were trying to figure out how to use. Today, you don't need to be an AI expert to go into GCP and use some of their libraries and build very sophisticated application using AIs. I think that this is what you're going to start seeing now. Definitely what we're focusing at Digital Asset is creating the tools on top of blockchain technology that will allow people like, customers like JP Morgan, like Goldman Sachs, like SDX to be able to build the next generation of, global economic network infrastructure without having to go all the way from the bottom up. And to me, that's just a natural evolution of technology. And it's you're going to see more and more, and the acceleration will just get faster.
Thank you. David, to say something?
Well, I'm just nodding a lot. Yes, I completely agree with you, Val. It's part of clearly the adoption cycle of this new technology is a lot about ergonomics, right? It's how easy is it to actually deploy and utilize. The first time around, the early adopters have to really will have a harder time of it when it comes to implementation than those who follow in their footsteps. I mean, certainly, we feel that when we were implementing the first regulated FMI with a CSD on a DLT, that DLT, we had to, there was not a playbook that we could use when it came to how to actually build and implement that particular system. So we had to work really closely with regulators to identify where their concerns were and how we'd address those in the technology and in the structure of the organization. But I have no doubt that, and we're already seeing it with the subsequent versions of R3's Corda that we've been deploying to support our private ledger, that functionality is obviously improving all the time. It's the nature of technology. If you don't improve it, then you become obsolete pretty quickly. So definitely, we're seeing that already in terms of the ease of adoption of new functionality. So it's, and that sort of move from being base layer to more building block kind of ergonomics around implementation is something we're seeing in all sorts of different parts of this world at the moment. And certainly, we're really excited to work with Digital Asset on doing exactly that and using their technology to accelerate the ability to deploy new functionality on chain. Since again, the technology has now evolved to that particular state. But I have to say, it's happening really quickly. I mean, you couldn't do what you do today, what you couldn't do just a couple of years ago, what you can do today, thanks to improvements and enhancements around technology, specifically around usability and the sort of toolkit approach that we see that organizations such as Digital Asset are actually employing when it comes to providing that technology to their customers.
Hey, sorry, I know that there is, I think, Mathew, you might be waiting to come in, but David, can you give us an example?
Of what? Sorry.
Well, of, from your customer's perspective, what's changed for the better?
What's changed for the better would be for us, it's that the elimination of additional parties in the process associated with the traditional settlement cycle. So using DLT to actually enable them to settle instantaneously, rather than to actually have to go through the clearing and settlement process that exists with the traditional T+2 cycle associated with bond issuance and execution. But is that the question that you were asking, or are you coming at it from a slightly different
angle? I was just curious, to sort of see what benefit the end users see from all this process.
Elimination, so risk reduction, cost reduction, sort of middle and back office staffing reduction, no need to reconcile across multiple systems associated with that particular chain. So they're very real and I think pretty exciting developments. So that current settlement process has been in place for something like 20 odd years now. So this is a pretty massive leap forward to go from having to wait 2 days to actually settle a trade to I've settled. Done. But
you see, until now, I've always heard at conferences that there is a perfectly good reason for it being T+2, and now suddenly all those reasons have disappeared. I
mean, I would.
Can I start? Oh, you go ahead.
Sorry, go ahead. Yeah, I was just going to say, back to your kind of specific question in terms of do clients want this? I think the answer is overwhelmingly kind of yes, and I think that's a function of the last 2 years. A lot of, when you look at the whole institutional landscape, there's been so much investment of time to kind of initially probably drawn a little bit by the appreciation in cryptocurrencies, but really just thinking through and properly understanding the underlying technology in a way that perhaps they didn't do 2017, 2018, when the technology was obviously talked about a lot, but the application wasn't that straightforward from a commercial perspective. So I think you've seen a real quantum leap. And so there is just a much better application and, to the point that everyone's made on the panel in terms of the benefits. And so, as you talk to kind of, asset managers, corporates, kind of insurers, even pension funds, people appreciate where this could actually kind of have a profound impact on their business. And I think it's fair to say that the technology is not necessarily right for every individual market right now, but it will over time evolve and will have some application. And so, certainly from our perspective, some of the things that we have done and we've publicized has just drawn a huge amount of interest from our broad client base. And so I've been, kind of astonished by that. And I think it's fantastic on many of the projects we're working on. And I guess to David's point, the benefits, do manifest themselves in different ways, be it kind of risk reduction, cost efficiency, speed of settlement. That finality of settlement, that precision is actually kind of, key when you start to think about the use of liquidity, capital, etc.
But also, it's a sorry, Yuval. It's a there's a pretty strong sense of momentum as well as these projects actually go from being proof of concepts to actually going live. In that, what you're seeing as all these participants are being involved in these projects and actually taking and benefiting from the technology is that they are building out capacity internally so that they can then the next opportunity that comes along to leverage the technology is that much easier to implement, because they already have in-house the skills and technology infrastructure to actually consume whatever the output is, or input whatever the input needs to be into that particular service. And we've seen it on SDX with the fact that you could once we've proven that we could settle tokenized cash or settle securities and tokenized cash, we also then moved on to proving that you could you could, from a legal and from technology perspective, actually settle them in central bank digital currency as well. So because it's only like it's another iteration, another step towards that end goal, because now you've got a whole bunch of participants who are already integrated to the platform, who can who are used to be able to actually do DVP, but for tokenized Swiss francs in the case of SDX, that's only then therefore one step away from doing the same process but using central bank money, so CDBCs on the wholesale side. So it feels like, you know, each of these incremental sort of projects are actually bringing the whole market forwards. So the benefits that you're referring to are part of the sort of emerging aspects of all the projects that everyone's now moving into production, and they have this sort of benefit around both in sort of all the actors and all participants all becoming more able to actually help with the acceleration of the adoption of what is really going to be the financial markets infrastructure of the future.
Thank you. Yuval, please.
Yeah, I just wanted to real quick address, and I want to I'm going to have a fairly long explanation with what you said, which I think is a good point, that the whole market is now saying, why do we even need real-time settlement? I think it's a good point. And I think that one of the problems is that those that don't want blockchain technology say you don't need it. Some that understand market structure also say you don't need it. And I'm one of them necessarily. I'm actually one of them. But then there are those that understand blockchain and want to talk to all the benefits. Why do I need to wait 2 days for my money to move? One of the things that people don't understand is that if you're a market maker in capital markets, you don't want real-time gross settlement. It's actually very bad for your business. You actually benefit from netting. Now, the problem is that in today's world, everything is very binary. It's T+2. And I think that the world is not binary. I mean, if we just take the events of last year with GameStop, it would have been great for the market from a risk perspective, as a lot of people talked about here, if GameStop could have settled in real time and not create this really bad risk profile in the market. The problem is that the technology today doesn't allow you to know where collateral or assets are at any given point of time. So even if you wanted to settle in real time, you don't have that capability. So the reason why I am bullish on the technology and the value that it could give to the market, it's not that the technology forces you to go to real-time settlement. There's nothing that forces you. You could use blockchain technology and get a lot of risk reduction, know where collateral is, manage it better on a T+2 settlement. That does not mean that you have to go into real-time gross settlement. But if there is suddenly this systemic risk that exists because there is GameStop or anything else, the fact that everybody knows where assets are at any given point of time does allow you to accelerate settlement. And you're seeing many exchanges all over the world that are talking about a use case of acceleration of settlement without necessarily impacting the rule that all equities should settle in T+2. So to me, I still see massive benefit for the technology without having to say you have to go into real-time gross settlement kind of as a default scenario.
And I just wanted to add a very quick point here. We actually interviewed about 60 firms last year on this specific point, right? I think people want choice because the markets aren't one market and one size fits all. There is asset classes that are very risky, counterparties that are risky, where you would maybe want to immediately settle, right? But today, you theoretically have choice, but it's a very expensive thing to do. So I think what this will do is it will make choices cheaper and more economical, and therefore lead to much better outcome based on clients and a capital situation. So I would really emphasize the choice part here, not just T+1 or T0.
Thank you. We have one audience question so far. So if you'd like to ask a question, please send it to us. Now, before we get to that, I wanted to touch on regulation and the way this space is moving. David, you already referred to it. It's breakneck, nonstop. I think you all know it better than myself, that it's pretty intense. So how being a large regulated financial market infrastructure or a bank, play in this sort of arena where lots of competitors are much more nimble and able to respond much more freely in terms of the regulatory aspects as well. Scott, would you like to start us off?
Sure. I think that probably is one of the reasons adoption in the regulated markets is a little bit slower, is because actually, there are a lot of rules that are there for good reason. We've seen a bunch of things in history that have created the set of rules that we've got today, and outside that space, then there's still a lot of more risk that individuals might want to take, but I think institutions may not be able to take on behalf of their clients. So, when we look at that differential, regulation and this legal certainty of what happens within the regulated markets, I think is a foundational, outside the technology. Like the technology, let's assume the technology is like embedded, it's going to happen, we're fine, like it does work, it's getting better, okay. But if I want to see real risk on the table, then I want to see participants that feel comfortable in the rule of law and under the jurisdiction that you're going to put that risk on the table. And I want to have probably a sense of confidence around a regulator that understands how this technology works versus another one. Is it different at all, or is it just another layer? If it is different, why is it different? And kind of how does that fit together? That takes time to evolve. And we've seen that through, a series of conversations leading up to the pilot regime in Europe, and a bunch of different other sort of regulatory bodies around the globe. We see it in the BCBS paper and the trades writing back to that BCBS paper about the regulation around crypto assets and the time it's going to take to get to a point where there's comfort in moving forward on sort of the cost of capital or how that fits together with different regulatory regimes that actually quite candidly aren't going to land in the same place on day one. Those are the sorts of challenges I think it had from an institutional space compared to where we are at the moment, sort of outside that regulated body, where people can take the risk they want, and they take that risk knowing that actually they're not protected. They're not federally protected or government protected deposits. It's naked risk for speculation. That's fine. If we want to take that risk, that's okay. The institutions, they're not in the same place, and we need to think about it differently. But regulatory bodies getting educated by the broader market, taking their own view of how that fits into the existing infrastructure and meeting why those rules are there, not just saying I need to apply the same rules, but meeting why the existing regulations are there, I think is going to take a little while to bed in. And that time means that it's harder to get scalable risk adoption because of uncertainty about what happens in the case of one of those rules being broken, or a counterparty credit's different, and you don't have the same confidence necessarily on scalable risk until that's clear. So those two things play together. I don't know if others see the same thing, but it's certainly a very constant conversation we have internally.
Yeah, I mean, the only other points I'd make is I think that clearly, the regulations are evolving, and I think perhaps what I've certainly seen from kind of prior businesses that I've run is the kind of very symbiotic relationship we have, and we're kind of obviously looking to educate at every point in time, but similarly, there's definitely a thirst for knowledge from the global kind of regulators that we interact with. So we want to make sure whatever we do is appropriately regulated naturally. And I think there's a real willingness from the global regulatory bodies to work with, the broader kind of banking and beyond to facilitate that. It's going to take time, but I definitely think we'll get there. And I think what really is positive is the eagerness to learn and understand, the benefits of the underlying technology and what that can do to transform, the financial markets and the non-financial markets.
And yeah, Mathew, I think that's important because I think some of the regulators actually are running experiments, right? You just have to look at what they're doing in central bank digital currencies, right? So I think regulators are actively educating themselves either through the market and the participants, but also they're doing their own experiments, right? Because I think they all recognize that there is a huge benefit to this technology.
Absolutely. I think that Switzerland is good. Quickly getting a reputation for being a regulatory regime which has the benefits of clarity, as well as that sort of very cooperative and willing to learn and actually involved regulator and policymaker in terms of FINRA and the SMB. So the SMB, having been involved in multiple CBDC experiments now with us and banks and other participants in the industry, that has been, again, very beneficial for us as an organization to ensure that we're all educating ourselves, but also that we absolutely understand what the risks are as the regulators see it and how we address those risks. So it's a very much it's a meeting of minds when it comes to us having to understand where they're coming from, which is clearly always with the goal of investor protection. So how with that goal in mind, do the risks emerge that they see, that they associate with this technology, and then how, as we as participants and implementers of the technology, address those risks. But it's definitely, in the case of regulated businesses, something that you have to do, in close interaction with the regulator. It's not the same playbook that you could have as a sort of crypto native. Let's see what we can get away with and get find deleter and trim our business model a little bit. No, obviously, we can't come at it from that direction at all. We have to be with the regulator every step of the way, which is very much how we have been. And we're very grateful. I mean, I think FIM has been tremendously helpful for us and very supportive.
Rules in Switzerland, whatever next. We have 2 minutes left, so I'd like to tackle this audience question quickly. Yuval, if we could come to you, please. Does the panel think large players will build their own wallets?
Say that again. I'm sorry.
Does the panel think large players will build their own wallets?
100%. Again, if you think about what is a wallet, I mean, I don't see a difference between a wallet to an iPhone app that allows you access. I think that what's unique in the crypto world is that crypto assets are non-recoverable, and therefore the wallet needs to have more security mechanisms built into it. But at the end of the day, it's just a client app that allows you to access your assets. So yes, I definitely think, I mean, I don't know that for sure, but I would assume that Goldman and JP and SDX eventually will have wallets. I do want to remind people that currently the crypto market is $2 trillion in size. It will get bigger, but enterprise assets or traditional TradFi outside of derivatives is north of $100 trillion. And I don't think that if we're going to tokenize other assets, like, for example, the building that I'm in, if I lose my keys to my wallet, this building is owned by anyone anymore, right? So yes, I think that there will be wallets. I do think that the panelists here would be building wallets if they haven't already, is my answer.
Thank you so much. Anyone else?
Accounts by another name, right? Like it's a new name for an account, really. And we have lots of bank accounts and we'll have new types of accounts over time, and that's necessary. I think the more important question there is if I have a wallet with one institution, I have a wallet with multiple institutions, can I trade across those? And the interconnectivity between networks, be able to trade asset for asset across networks, is where the success of this will be. Otherwise, we have an interesting set of isolated use cases that isn't a market.
Scott, please make that happen.
And on that note, I'm going to have to stop, I'm afraid, unless anyone has any very, very burning additions at this point on the wallet question. No. Okay, well, thank you all so much. I hope you enjoyed the panel and found it useful, and enjoy the rest of day 2. Thank you.